Thank you for joining me for this presentation. My name is Brad Renard. I'm the Chief Publisher of Upside Options, and I would like to share with you my top 5 stocks to buy now for July 2019, and I will review our stock selection process. So the objective of the presentation is I've selected 5 stocks out of our professionally managed funds, and I would like to share them with you. And I will review with you our process of doing fundamental, technical, and quantitative analysis, also known as quantamental analysis. About Upside Options, we offer a non-directional income generation strategy that uses options, and we offer long-short strategies where we buy stocks that blend technical, fundamental, and quantitative analysis. We also have free trials available for our strategies. If you're interested, please go to upsideoptions.net/free-trial. And for accredited investors, please visit our sister company, qtrcapital.com. So the available strategies that we offer are the big cap growth. We buy stocks with strong technicals and fundamentals with a market cap of greater than $10 billion. We have the small and mid cap growth. That's where we buy stocks with strong momentum with a market cap of $250 million to $10 billion. We have contrarian. We buy stocks that have been out of favor for the last 6 to 12 months and they're starting to recover. We have sector rotation, where we concentrate in the strongest stocks within the strongest industry sectors. And then we have the Iron Condor Pinnacle. That's an options-based strategy. It's a non-directional income-generating strategy, and that typically generates 2.5 to 5% per month. And this strategy has similarities to selling covered calls, where it collects premium each month. So how do we select our stocks? We have a 4-level proprietary quantamental analysis system where we blend technical, fundamental, and factor-based quantitative analysis. We allocate about 4 to 5% to each stock. The portfolio is hedged to reduce drawdown during corrections. We follow strict exit rules so that it allows us to let the winners run, but our exit rules are fast enough where we can lock in gains to protect capital. So for example, in 2018, that was October, we went from 75% allocated down to 15% allocated in about 6 days. And that's when October 10th came along and then the market corrected by over 20%. So our services, our strategies finished up for 2018 in the plus 14 to plus 18% gain range, and the benchmarks actually closed down in 2018 for the year of minus 8 to minus 12%. More on the 4-level quantamental scanner. Step 1 is we do macro analysis. This is big picture analysis, the technicals, breadth, fundamentals, sector strength, investor sentiment, and that helps us modulate our bullish and bearish exposure levels. Step 2, we do a technical scan to find the high probability setups. And I'm going to cover some of this during this presentation. Step 3, we do a fundamental screen. Is the company strong? Is it growing earnings strongly? Is it growing revenue, return on equity, things like that? Step 4 is a quantitative screen. And this is more probabilistic using factor-based quantitative analysis. And then we use technicals to trigger our entries and our exits. So I'll go over each one of these steps as I'm introducing some of these stocks to you. So snapshot of today's market as of July 20th, what are we seeing? Well, we're going through earnings season. It just begun, and earnings growth is projected to be slightly negative. We have a slightly expensive market trading at 17.4 times forward S&P 500 earnings. We have continuous political uncertainty that can sell off stocks at any time. For the positives of the market, jobs growth is strong. It's actually excellent. Interest rates are low. Inflation is under control, near 2%, and the consumer is strong. Consumers continue to spend, which that drives 70% of the economy in the United States. The Fed is committed to lowering rates on July 31st. That's their next FOMC meeting. The negatives of the market, trade war with China, that continues to slow U.S. and global growth. Manufacturing economic data is weak. Corporate earnings are slowing. A yield curve that is flat and slightly inverted. The bond market is pointing to a slowing economy, and that's classified as the smart money. And we have conflicting signals. Cash is flowing into bonds, gold, defensive sectors such as utilities and real estate, but cash is also flowing into the broad stock market, pushing it up to the all-time highs, including the cyclical sectors such as technology. So this is not sustainable. One of these is going to be wrong, but right now cash is flowing into both. If you want to see the weekly analysis that we do, it's free. It's on our website. Please go to upsideoptions.net/weekly-market-update. So the first thing we want to look at is sector strength. Which sectors are outperforming and which sectors are underperforming? So there's about 80 sectors that we watch. This tool actually ranks the sectors. So for example, market vectors, agribusiness, these are all ETFs that I'm usually watching. And right now, agribusiness is ranked 1. Clean energy is ranked 2. Technology is ranked 3. Now that's the first thing I'm looking for. Where's technology? XLK. So technology is ranked in the top 10. That means that that's cyclical in nature. Cash is flowing into the market with technology leading. That's excellent. But at the same time, silver is climbing and we have gold climbing. So that's interesting. So again, we have these mixed signals. So I just want to make sure that when we're buying stocks that we're kind of in the top 20 sectors in this range. And I see technology in there, which is good. We got some financials in there, especially financial services and healthcare. Healthcare diagnostics, research, things like that. Those healthcare companies are doing great. Also capital markets. Okay, next step. Let's look at the indexes. S&P 500 index. Right now we are in a confirmed uptrend because we broke out to a new high. So everything looks good there. This is basically the 200-day moving average. This is a 50-day moving average. This is a 13-day moving average. And I care about support and resistance. I care about this level here. This was the January 2018 high. 2872. Care about this level here. This is 2945. This is really the breakout level, and we're still in breakout. So this market has been wanting to go higher, and investor sentiment is positive, and market is in a confirmed uptrend. The Qs. This is 100 of the largest technology companies, and this one also broke out. Now it did retest just recently on Friday, but what we care about right now is we want the Qs to stay over this breakout of 191. Small caps. This is the IWM ETF that tracks the Russell 2000 Small Cap Index. Here's the 200-day line. It's over the 200-day line, but this chart looks weak. So until the small caps start participating, and really until the IWM breaks over 160, we do not have an all clear signal, not yet at least. Big picture conclusion. So should we be buying stocks right now as of July 20th, 2019? Well, the answer is yes, from what we just saw and what we just analyzed from the big picture analysis. S&P 500 index, the Qs, those are all broken out to new highs. Interest rates are low. This is good for businesses and stocks. The job market is strong and still expanding. The consumer is strong, and this consumer continues to spend. That's 70% of the economy. The Fed is accommodative, willing to lower rates to keep the economy growing. So to see our free weekly big picture analysis, please go to upsideoptions.net/weekly market update. Okay, the first stock I would like to recommend is gold. And actually, this is not a stock, it's an ETF. So this is the Spider Gold ETF. First thing I want to do is look at the charts. This is the daily chart on the top. This is the weekly chart on the bottom. For the weekly, I'm looking at two moving averages, a 17-week EMA, exponential moving average, and a 43-week EMA. The 17 is below the 43. That's telling you you are in a confirmed downtrend. Basically told you from early 2013 through 2016, it said do not touch gold. You're in a long-term confirmed downtrend. 17 is back over the 43 here, and you can see that we got a breakout. So what we care about is this breakout over 128. Let's look at the daily chart. Daily means each candlestick represents 1 day. Down here, each candlestick represents 1 week of price action. Okay, so up here on the daily chart, I show a 13-day EMA moving average, a 200-day simple moving average, and a 50-day EMA. That's what this is. So here's the 200, here's the 50, here's the 13. We just got a breakout. This is the first time we've seen a breakout with gold in literally 6 years. So there's a high probability that GLD will continue to trend higher. However, if it starts breaking below 128, immediately exit the trade. It's failing and we're out. Another stock that you could play is GDX, Gold Miners. Same chart. You can see that the 1743 is back over the 17 is back over the 43. We've broken over 28. Here's the daily chart. This has not broken over yet. So you cannot buy GDX, not yet. You want it to break over and really stay over that breakout line for at least 5 days before you get in. If it doesn't break over and stay over for 5 days, don't get in. But you can get into GLD because it already broke above and it's already stayed above for about a week. Okay, the 4-level quantum mental scanner. So I'm just going to show you the analysis as I'm going through each stock that I'm recommending. So we just did the macro analysis. I just talked about some of the stuff that we look at for macro analysis. And I talked about the technical chart. I talk about the shape of the chart, and we'll look at that in more detail for each chart I show you. But the ones I'm recommending in this presentation are really all the same. They're all breakouts. So what we do is we have scanners and we're looking for different chart setups. And this is one of the more simple chart setups. It's a breakout. And that's what this technical scan does. It's finding certain types of setups. Then we do a fundamental screen. And I'll show you a little more on that for the next stock that I recommend. Stock number 2, Medtronic. medical company. They've been around forever, primarily known for their pacemakers, but they also have robotics and all kinds of monitoring equipment. So it's a very large company. Let's look at their charts. Weekly, daily. The weekly confirmed uptrend. 17 has really stayed almost over the 43 for a long time. Well, it pulled back a little bit here. 17's back over the 43. We got a breakout. 98. Here's the breakout on the daily chart. We want to make sure that we stay over the breakout for at least 3, 4, 5 days before you get in. If it starts failing below 98.79, immediately get out. It means it's failing. Could this stock go higher? Well, step one is we got a breakout. So momentum could kick in and you'll see many more buyers stepping in, and this could climb plus 5%, plus 10%, plus 15%. We just don't know, but it's a fresh breakout. That's why I'm recommending it. Let's look at the fundamentals. So this is courtesy of MarketSmith. And this piece of software allows me to see the fundamentals of the company. The first thing I look at is over here. This is earnings growth, or really the total earnings per share that the company is going to generate. And I want to make sure that they're going to keep on growing from 2019 to 2020 to 2021. And you can see that this company is growing about plus 5 to plus 8%. Next thing I look at is earnings down here. Earnings growth for this quarter, July 31st, 2018, and then the October quarter, 2018. January, and then April of 2019, and I see what their earnings growth was. So a plus 4, a plus 14, a plus 10, a plus 8. That's excellent. Their next earnings is going to be August 20th. This is revenue growth, the next line down. So they're growing their revenue also. And then I look at all these numbers over here. And most of these are proprietary ratings that combine certain indicators, certain economic data for this company. EPS rating, for example, usually above 70 is good. SMR, it's looking at margin, sales growth, and return on equity, for example. So those three are combined in this single indicator here. And this, it gets a B, which is pretty good. And the PE is trading at 19 times earnings. And market cap's 135 billion. So this gives you a snapshot of the company. Overall, what I'm looking at is I'm looking at fundamentals for Medtronic, and the fundamentals look very good. Okay, back to this 4-level Quantamental scanner. I've already given you an example of doing big picture analysis. Should we be in the market or out of the market? And the answer is we should be in the market right now. Technical scan, we're looking for breakouts. Fundamental screen, I just showed you the MarketSmith page and showed you some of the data that I look at. And next I'll show you a quantitative screen. Stock number 3, CarMax. Very large seller of used vehicles. Let's look at the charts. All information is embedded into the charts. And it tells me that investors believe that this company is doing very well and they're going to continue to do well. So this one broke out. What I like also for this type of chart is it consolidated for a long time. Literally from 2015 through 19, it didn't do a lot. It kind of stayed in this $50 to $80 range, and now it's starting to break out. And that increases the probability that once you get a breakout, that this stock will trend higher. Let's look at the fundamentals. Look at this earnings growth. Very strong earnings growth, plus 27, plus 35, plus 53, plus 20. Next earnings is going to be September 24th. Overall earnings per share for each year is growing. This company is growing at pretty much a plus 10, and according to this package, they're growing at plus 15% yearly. EPS rating is 96. Excellent, excellent rating. They also have this other indicator called composite rating, and that includes lots of different things in this single rating. They're literally in the top 3 percentile. Out of 5,000 stocks that we look at, they're in the top 3 percentile. Stock number 4, Ally Financial. This used to be GMAC, a part of General Motors, and they spun out many years ago as their own independent bank. They have Ally auto loans, credit cards, bank, online banking. They're doing very well. Let's look at the chart. This one is nice because it has a nice deep cup right here. This is, again, the technicals looking for a particular chart setup. So here's a weekly chart, 2015, 16, 17. I can see that the 17 is over the 43. I can see that it's just broke out, and I have a nice cup that's spent about 1.5 years developing. That's very nice. So here's the same cup up here on the daily chart, and we just got a breakout. Very nice. This is called a fresh breakout. Fundamentals of Ally Financial. These numbers look really good. Plus 40, plus 31, plus 18, plus 17. Revenue's also growing. These numbers over here look really good. They're growing at plus 16%. They have positive growth here from year to year to year. PE is low. It's actually a very low PE of trading at 9 times earnings. Market cap of 13 billion. Next earnings date is October 25th. Okay, let's talk about quantitative because I haven't showed you an example of that yet, and that's this. So quantitative analysis is basically called factor-based quantitative analysis, also called econometrics, and it uses multiple linear regression models. So it's beyond the scope of this presentation, but what we get is we get an output that looks like this. And it gives me all these probabilities. And what we feed into it are all different factors. A bunch of economic data, some like technical data, and we have our own 15-factor model that drives this probabilistic model. This basically screens about 4,000 stocks. That's how long the spreadsheet is. It goes to about 4,000 stocks. And whenever I'm looking at a particular stock, if I like the charts, or I like the technicals, if I like the fundamentals, then I'll come into the quantitative piece of it and the probabilistic piece of it, and I'll see what the probabilities tell me. And what it basically tells me, so for example, here's an example right here, ABV, ABBV. Now this is old data, so please don't use this. We have to run these once a week. But ABV, when I ran this one, and I think this is a couple years old, it had 11.06, and that's a very high probability. And what it tells me is that most likely at that time, AbbVie was breaking out, and it had a high probability that the breakout would succeed and the stock would continue to move higher. So that's what quantitative analysis is, and I use this as a final screening mechanism to give me a higher probability of opening a trade that will work. Stock number 5, and the last stock, is Intuit. They have TurboTax, QuickBooks, Mint. Mint is an online site that has about 25 million users where people track all of their financial information. They can link their bank accounts, credit cards, things like that into this portal. They have payroll. Let's look at the charts. You can see that this company has been doing very well over the last 10 years. It's literally a 3-bagger since 2014. It went from 100 up to almost 300. It's pulled back a little bit here, and this was the first breakout. You could have gotten in right here for this breakout and made a little bit of money, but it would have thrown you out probably. I'll talk about exit rules in a minute. And then once it gets back over this breakout here, and I'm using this line as a breakout, just large candle. Whenever you see a huge candle, I'll draw a line right across that. And I'll say, okay, that's my breakout. I want to make sure I stay over that breakout. If it starts failing below, then I'll be out. Sometimes I just want a higher high. So my entry would be about right here. That's why I'm recommending the stock, because the entry is around 275, and right now we're on around 279. So that's not bad. Fundamentals. Earnings look really good. Earnings growth. Next earnings is August 21st. These numbers look really good. This composite rating, look at this, 99. It's a top 1 percentile stock based on this proprietary indicator that looks at lots of different variables to create this composite rating. And they're growing at plus 18%. Look at this right here. From 2018, 19, and 20. This is their earnings per share, and they're growing fast. Okay, those are the top 5 stocks. Let me talk about entry rules and exit rules, because you do not want to hold a stock if it starts exiting on you. Best to enter a position during a fresh breakout. I just showed you 5 stocks that have fresh breakouts. Not wise to chase a stock that has already been running, and I'll show you an example. So if it's already been up 5-6%, I don't like chasing those. But you could try to get into them when they have a pullback. But sometimes I'll just look at it and say, well, I missed it, I'm moving on. But it's an option. If it's already up 5-6%, it's above breakout, you can wait for it to eventually pause and pull back, and then enter the stock when it takes out a higher high. And sometimes it'll move in waves. Stocks usually ebb and flow, and they move in waves. So you can catch the next wave. There are always fresh breakouts happening. Just focus on those. Here's an example, a stock you don't want to chase. Here's Visa. Typical chart. Here's the weekly. This is just super strong. Here's the daily, climbing up. It pulled back. This was the October through end of December 2018 correction. And then it took out a new high as of March 2019, and this was the breakout right here. So you really needed to get into this stock around $155. And if you missed it, you missed it. But you can see that it's climbing nicely. Here's the 13-day EMA. Here's the 50-day EMA. Here's the 200-day SMA. And it's just been climbing and trending up beautifully. But I don't like to chase those. If I missed it, I missed it. Exit rules. If a stock starts to break down below its breakout level, exit the position. It's best to use rules, do not use human emotion. If you let human emotion drive your actions, you will lose money. So if a stock starts to break down below its breakout level, exit the position. If a stock stays above its 50-day EMA, exponential moving average, it's best to hold the stock and let it run. As the stock trends upward, if the stock starts to break down below the 50-day EMA, exit the position. If you're exited out and you want to get back into position, wait for the stock to take out a higher high, then re-enter the position. One thing we do is we maintain an active hedge, and that's kind of unique. A lot of people might say they're long short or they're a hedge fund. Reality is hardly anyone hedges. So we maintain a continuous active hedge in our portfolios. So about 8% of the cash is allocated to the hedge. It's an options-based hedge. We're using the S&P 500 index for the hedge, and it helps reduce drawdown when the market corrects greater than 4%. And these days, that happens quite often. We can easily have a 4 or 6, 8% correction, something coming out of Washington, D.C., that we're blindsided and the market's down. And our hedges will usually generate a 200 to 300% return whenever the market's down about 4% or greater. Which is very unique is that we're paying for the hedge selling far out of the money call options. And that allows us to keep the hedges running continuously. It doesn't impact the portfolio because we're paying for the hedges. We're paying for time decay of the hedges. We're paying for loss of value of the hedges if the market starts climbing, and we can keep them on. So that is one thing that we do, and that is a major differentiator. If you want to learn more about that, you can contact us. If you actually have your own portfolio and you want to open some of these hedges, just send us an email and I can give you more information on what to do. But it does take a lot of work. They have to be rolled every 2 to 3 weeks, 4 weeks. They have to be actively managed. They have to be constantly pushed up. They take effort to keep these hedges on, but they're worth it. Last slide, and then we're done. Let us do the hard work for you. So please consider trying one of our services for free, where we do the laborious work in finding those fast-growing stocks that are ready to buy. You can receive a continuous stream of high-quality stock picks. Just about every day, every other day, we're opening a stock or two in one of our portfolios. And you can consider enabling auto trading. So we do the trading for you whenever you auto trade. So we open the trades, we close the trades, we do everything, so you don't have to do anything. So free trials are available at upsideoptions.net/free-trial. And for accredited investors, please visit our sister company, QTRcapital.com. Thank you very much for your time. And again, for the weekly analysis, we do very robust weekly analysis, and this is free. It's at upsideoptions.net, weekly market update. Thank you very much for your time, and I'll see you next time.